Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, August 17th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. This is for informational purposes only. I am not a registered financial advisor. I cannot give you individual investment advice. Please do your own due diligence on any ideas that you hear on this podcast or video. It's your money. It's your responsibility. Okay, so shameless plug for the Actionable Intelligence Alert newsletter. I just wanted to go over what I offer as part of my universe of media offerings. About a year ago, I moved the entire operation basically onto Substack, which is a tremendous platform. It's been working out very well for me. And so what I offer there is, in addition to this weekly video, which many people seem to enjoy, we continue to grow. It's been a terrific experience, and it's acting as a funnel towards these other offerings. But if you're interested in getting deeper, I actually have a free weekly email newsletter that I send out usually on Monday or Tuesday. And basically it is a distillation and collection of the things that I've read or the videos I've watched or podcasts I've listened to that I found interesting for that week. Sometimes I'll put up some good quotes from investors or some type of anything that I find interesting or that applies to the types of discussions that we're having on these videos. And so that's free. You can go into the show notes below, and there's a link that will take you to the free newsletter, and you can subscribe. It's actually also, I think, the first pinned comment in the comments section will take you there. In addition to that, if you want to sample my stock picks or the companies or the ways that different investment vehicles that I invest in, you can get a sampling of that by becoming a Patreon. There's a link in the show notes for that, a Patreon supporter, $5 per month minimum. And what that will get you is a one-time pick. So the most current pick in the newsletter, the most current addition to the portfolio, I will send you the write-up for that specific stock or company. That's a one-time pick only. Some people think that they're just going to get the every pick. That's not how it works. It's a one-time situation to motivate you to become a Patreon, to support the channel, support my work. This is reader supported. I have expenses, and that will give you an opportunity to sample some of my writing and type of companies that I'm investing in. So the main offering obviously is the Actionable Intelligence Alert paid newsletter. It's $179 per year. It's 12 monthly issues. We have a model portfolio in there. Basically, it consists of the themes that we're talking about in these videos and how to take advantage of that with specific companies. So it's a lot of resource stocks, special situations, things like that. And basically things that I think are undervalued that I think have a catalyst to become revalued by the market. And also, in addition to the paid newsletter, we also have a Discord channel for subscribers, which you'll get access to. And that's been tremendous. I really enjoy the interaction we have on there. We have a lot of smart people on there. There's a lot of interaction. A lot of times before I can even update what's going on with the company, the people on the Discord have updated whatever's going on in one of the portfolio companies. They also bring other ideas that I haven't considered before, news items, discussion around different things. So it's a really dynamic and very highly educated and motivated group of people that it's really a good tribe and good community. So it works out pretty well. So that's what we offer in the Actionable Intelligence Alert media empire, if you will. And if you are interested, you can basically, there's links in the show notes to all of these offerings, and you can peruse them at your convenience. And we, obviously encourage you to become a subscriber. at least even to the free weekly newsletter. That's I think that's really been useful for quite a few people. Okay, let's get into the weekly news. So, look, I'm not going to pick on these politicians too much. Yay, Trump's policies are the best. Kamala's a socialist. All this. This is kind of first level thinking. What I want to impart onto you is that, again, we're in decline. We're in terminal decline. Part of the problems that I have with our system, the way that it's set up, is that it doesn't lend itself to long-term solutions, right? Because the election cycles are 4 and 2-year election cycles. And so there's no incentive, there's no long-term planning, there's no looking at long-term problems. It's basically, I have to get ready for the next election cycle, and it leads to a lot of pandering and a lot of bad ideas on both sides of the aisle. And you infuse into that a donor class of special interests that give money, because you need money to be successful in politics, a lot of money. And so most of these bums never had a real job. And so they're not going to spend their own money because they don't have any, most of them. And so what they do is, they have special interests that give them money. And then the expectation is that you will do the bidding of the special interest group in the legislator when you become a legislator. That's just how it works. It's bribery. That's basically how it is. Everybody gets what they want, except for the average person who gets the short end of the stick. And so what you get is a lot of dumb ideas that basically appeal to people that are not educated, that don't really know what's going on. And it's just part and parcel of what you would see in a multicultural, spoils-based system. That's what this has turned into in the United States, a multicultural, spoils-based empire in decline, where everybody's trying to grab whatever they can and steal as much as they can or get something for nothing. And that's what happens when you don't have cohesiveness, when you don't have a high trust society. But these are discussions that we've already had. This is not going to change. So this is the type of pandering that you get. So finally, Kamala Harris came out with some of her economic policies. I guess for a while there, I don't know, I don't go on her website, but what I have heard in news reports were that you could go to her campaign website and there wasn't anything, even a policy page. So she finally came out with some ideas this week to pander to low information voters, people with short-term thinking, people that just want to grab something for nothing. So what are we talking about? This is from a New York Post article, and it kind of devolves into, it was written by a guy that's a big time Republican advisor to previous administrations. So you get a lot of this, they rate the ideas with hammers and sickles. I'm not going to get into socialist, communist, whatever. This is pandering is all it is, okay, to try to get votes. So this is what people do. And I'm going to give you the antidote to this after this, but anyway, this is what she said. So basically, the centerpiece of the Harris plan is the imposition of federal price controls on, quote, greedy corporations. We've heard this before, right? She says are, quote, price gouging consumers. Landlords would be prohibited from raising rents more than 5% a year. So first of all, you can say whatever you want when you're on the campaign trail. Whether or not you can actually get this legislated and then have the courts uphold it would be different. I don't really think that you would be able to pass a nationwide rent control program. I think eventually you will, because the United States is going to devolve into basically, low information, low IQ peasant class of people run by a bunch of technocrats, and people will, go for this type of stuff because they don't understand history and economics. But I don't think we're there yet. So I don't think you could get this through. And even if you did, I think the courts would overturn it. And again, I don't think this stuff's going to happen in the end. It's just pandering, though. But it just shows you the mentality and why the system is not set up for long-term solutions, like, dealing with the debt, dealing with the entitlement, not, our inability to pay for the entitlements that we've committed to, and a whole slew of other issues. So this is what you get instead. Goes on, Harris's plans to reduce grocery costs, which includes working with Congress to ban, quote, price gouging or stopping sellers from pricing their products excessively. So let me get this straight. The real problem in my mind why we have the inflationary issue that we had, and basically people's standard of living dropping 20 to 25% since the pandemic, is because the government and started this whole situation. They shut the economy down over the flu, and then they jammed all this money, fiscal spending, borrowed money, and the Federal Reserve printed a bunch of money, buying securities. That's what they did. Government issued a bunch of debt. The Federal Reserve bought it with created dollars. You shut the economy down, so you have no supply, no production, and of course, more money into a system that has less goods, you get price inflation. This is what caused it. And so now, this is what I've said before. These politicians are horrible. They create the problem, and then they, instead of addressing the problem, which is the Federal Reserve and the excessive spending of the federal government, okay, which is the root cause of the problem, okay, and not having real money, whether you think that's Bitcoin, gold, whatever, instead of having that and dealing with those facts, because that's not popular, because that doesn't allow for, unstoppable spending, which is in pandering to get elected, this is what you get instead. There's no discussion about the Federal Reserve. There's no discussion about how money's created, what money is, what's the history of it, what is that you as a household, you as a business owner, you as a manager in a business have to meet budgets, but the federal government doesn't have to, and everybody just thinks that has enough cognitive dissonance to believe that that's okay. These are the root problems. So you create these problems, and Kamala Harris didn't create the Federal Reserve, and either did Trump. I mean, this is all systematic, okay, for decades and decades and decades. It's not going to get turned around. It's going to result in eventual economic collapse, okay, and a dissolution of the United States as a political entity. But that's further down the road. So instead, this is what you get. So Kamala Harris, who's never ran a business, doesn't know anything about anything really, she's kind of a boob. So is Trump, for that matter, when it comes to economics. And all the other previous presidents pretty much were. These people are just lawyers, most of them, or in Trump's case, a real estate guy. Okay, they don't know anything about policy. They surround themselves with other technocrats that have their own agendas, and they run with this stuff. And so they think this will play with the American people. And it does, because we have low IQs, low education levels. People, have short-term thinking. Their time preferences are skewed. And so this is what you get. So what are they going to do? Set up like a Gosplan bureau that goes to, to Kroger and HEB and Ralph's and Vaughn's and says, well, the price of, peaches in heavy syrup is 10 cents too high. How are they going to determine this? What experience are they going to use? What information do they have? So the prices are set, these grocery stores are low margin businesses anyways. I mean, they run on razor thin margins. And so you see where the inflation was caused by. You see where the inflation was caused by in the housing market. Okay. You see where these things were started, but there's no discussion about that because the ruling oligarchy benefits from the Federal Reserve. Remember the Cantillon effect I talked about? The closer you are to the money printer, the closer you are to the king in Cantillon's time, the closer you are to the gold, the more you benefit. So they're not going to get rid of the Federal Reserve that causes these problems. They're not going to spend money only on what revenue they take in. They're not going to do it. And so this is what you get. So they're going to ban price gouging. Now, this won't pass Congress unless you get an overwhelming Democratic majority. Maybe they'll get something in there. I don't know. But I want to go back to price gouging in rents. It's interesting that Javier Milei, the anarcho-capitalist, Ludwig von Mises, follower of economics, free markets, basically got rid of rent controls in Argentina. And guess what happened? The supply of apartments on the market exploded and rents started coming down. And so the free market works. You know, the reason people don't want free markets is because they don't want to be responsible for themselves. They want somebody else to take care of them. And if you offer free money to most people, they're going to take it. Why wouldn't they? You know, people in the country are about half the population is struggling to survive. And so these type of policies make sense to them because they're looking for a life ring. They're not interested in hearing about the Federal Reserve and the government caused this. Hey, you say you're gonna, my rent's out of control, I can't survive. You say you're gonna limit it, I'm all in on that. You say you're going to have price controls. Price controls don't work. They've never worked anywhere. They cause shortages and they will cause businesses to, you know, you can see pictures people could show you of, like in Venezuela, like a bodega before price controls. They show the guy, he's kind of plump, the shopkeeper. I saw this it was kind of funny. They had a side by side. It's not really funny, it's sad, but it's illustrative. They show this bodega owner standing there. He's kind of got a little pot belly. Whole shelves are full of stuff. The price controls go in like 5 years later. He's very thin because, you know, they had shortages and there's very few things on the shelves. That's what happens. But, you know, boobas, you know, this is what H.L. Mencken called the average voter in the U.S., boobus americanus. You know, this isn't right. Somebody needs to do something. And so the politician will do something. And so here she goes. Thirdly, she wants to, quote, cancel medical debt for millions of Americans and to help them avoid accumulating such debt in the future, unquote, capping insulin costs at $35 and out-of-pocket prescription drug costs at $2,000. Well, this is one of the biggest the healthcare insurance, the healthcare system in the United States is the biggest money-making mafia that exists. Look at this Gollum-looking senator from Florida, Rick Scott. He's a perfect example of what I'm talking about, okay? Go look him up. He looks like an alien, okay? Bald-headed, alien-looking, you know what, okay? He was the governor of Florida before DeSantis. And before that, he was a big shot over at United Healthcare, right? Which is big insurance company. Okay. People don't understand like the history of health insurance in this country. The reason we have employer provided health care in this country, how it started was during World War II, there was labor shortages in the defense industries, right? And so at the beginning of the war, the defense, you know, people were getting drafted into the military, the men, so the labor force was being sucked out of industry. And so initially, the defense contractors that were getting orders from the government started raising wages. Well, this was during the Roosevelt administration, okay? And so they weren't going to have that. And so they put wage controls on the defense contractors. You can't just raise wages to attract workers. And so they found a workaround and they started offering employer provided health care and other fringe benefits. That's why you even have the fringe benefits that you have. That's where it started, okay? And so over decades, people came to expect their employer to provide health care. And obviously, with this mafia that we don't have a free market in healthcare in this country. What product do you buy? Let's say that you went into Chipotle, for example, and you wanted to get a steak bowl, okay? And there's no prices. You just like, I want that steak bowl. I'm hungry. Load it up. Yeah, go ahead and put 2 scoops of guac on that thing, okay? And then you get to the end, and they ring it up, and it's $114. You'd be like, whoa. How'd this happen? Well, that's what it costs. Well, you don't have any posted prices. That's what it costs. You know, that's kind of how the healthcare system works. We have this third-party payer system. Either the government pays in Medicaid and Medicare, or your healthcare, your insurance pays. Okay. And so then you had, you know, more regulation being put on it. And so you have these oligarchs that are in that industry putting more and more restrictions, you know, against competition, cross-state selling of insurance. You don't have a free market in insurance, health insurance. You don't have a free market. You know, you go in and you just expect, you know, well, the insurance will pay for it. But now because things have gotten so expensive, what's happened? Your deductibles have went up. Your insurance, you're paying what? $1,500, $2,000 a month for a family insurance, and you get a $10,000 deductible. That means the insurance doesn't even cut in until you spend 10 grand. And you're telling me this is a free market? The same thing with this insulin. This is another rigged thing. Insulin production should be at this point generic, should be a generic drug. But you have legislators, you have these little mafias, okay, that are looking out. And again, who's one of the biggest contributors? I pointed this out in a video like 2 years ago. Who's one of the biggest contributors to politicians? The healthcare industry, because they want to maintain this mafia. And then you had this Obamacare, which didn't solve anything except was the biggest sop to the insurance companies of all time. Look at the price of the stocks of a lot of these insurance companies, health insurance companies. They've done tremendously. Rick Scott's done tremendously. He's a big shot senator now from Florida. What did he do about it? He wasn't going to do anything when he was governor. You see how it works now? Do you get it? And so instead of dealing with those problems, instead of going after that antitrust and disassembling all that legislation that benefits these companies, no, we're not going to do that because they give me money. I need the money to be elected, so I do their bidding. They're not going to do that. So instead you come up with this dumb, we're going to cancel medical debt for millions of Americans. And of course, people that are struggling, they have nothing. They have no stake in the system. They're a Russian serf, as Steve Bannon said. Why wouldn't they vote for that? I don't care. I don't care where the money comes from. I don't care that wealthy people need to be taxed because they have a spirit of envy. They're despondent. They don't understand the long-term effects. So this is what you get, pandering. And Trump's no different. Tariffs, he's going to do this, he's going to do that. It's the same situation. We're going to bring industry back. You could have such a dynamic economy here, okay, that would explode. You would have labor shortages here. Just dismantle the regulatory state. And people say, well, John, what would we do? Who would build the roads? Who, the FDA, the USDA, who would inspect our beef? Well, you get food poisoning anyways. These things don't, where was the SEC? As Doug Casey calls it, the Swindlers Enabling Commission. It's always after the fact they show up. We're going to take all this salad offline. Hold these companies accountable. Hold the managements accountable. A perfect example is this ridiculous TSA organization they started, okay? Who should be who has more incentive to be responsible for your safety on an airplane? A faceless blob government agency, the TSA. Have you seen these people down there? Take your laptops out, your potions, your water, your juices. I mean, really? You feel safe taking your shoes off and getting patted down by some slob in a government issued Halloween costume? That gives you, or should we hold the airline accountable that they should be making sure who gets on their plane? They should be responsible. They'll create a consortium. They'll get the security straight if you force them to and hold them accountable. And then you'll have to pay for that. If you want more security, you'll pay for more security. But no, that's not how Boobas thinks. Somebody needs to do something. Everybody that goes through there knows this is ridiculous. I can come up with 100 scenarios of how to get around that security. Anybody could that has a brain. But, everybody just goes along with it, shuffles along, takes their shoes off, have some stranger patting down your genitals just because, giving you ridiculous orders. Take your laptops out, your juices, your potions, your toothpaste tube is too big, throw it out. Because they have a government issued Halloween costume on. I mean, this is not, I was just watching the video the other day of the reenactment of the confrontation of the militiamen at Lexington with the British. Okay. That doesn't exist anymore. Most people in the US are whipped dogs that, roll over and urinate on themselves when a government so-called authority figure barks some doofus order at them. Look, I believe in law and order, but it's getting ridiculous, and it's not going to change. I'm just pointing this out. And so you need to understand where things are heading over time. This is not going to work if they even if it gets implemented. Again, you got to get it through. You can say whatever you want on the campaign trail and the stump as running for president. It's not like a dictator. You can just do whatever you want. You got to get it through some of this stuff through Congress, and then the courts are going to have people are going to file lawsuits and block things. It's real easy. Okay, we got to disband the regulatory state, the administrative state, and these oligarchies, that pay and are combined with the regulatory and administrative state for their own benefit. That's the real problem, and no one talks about that. People fringe like me that are out on the front lawn, yelling at the moon, "Get off my grass," and that's it. There's nobody that's actually, a few people, but they're not going to get elected because this is not what Bubis wants. Bubis wants free stuff. Bubis feels entitled to this because of decades of welfare and free stuff. I mean, we've talked about Social Security before. This is a Ponzi scheme. It's taking money from one group and giving it to another. It's just a transfer payment. It's not an annuity. It's not a 401k. You don't accumulate any real wealth. Okay, it doesn't belong to you. Okay, they can change the terms anytime they want, and everybody goes along with it. When we know the long-term return, if you just would have put all of that money into an S&P fund for accounts for people, and then they could transfer it to their heirs after their death, what's even if you would have averaged 6-7% a year over a 40-year working life, you would have high six figures, low seven figures every worker. Yeah, there'd be ups and downs, okay? But just manage it like that. Just put it in the S&P. You'd have more investment funds in the US. I mean, you shouldn't even be doing that, a system like that, but that would be better than what we have now. Okay, but we're not going to do that. Will get corrupted because then you'll have people like Vanguard and BlackRock in there creaming off fees. So, anyway, this is what came out. So I don't get into the socialism, communism. The U.S. is it is moving towards a European type soft socialism. So what? It's been like that since the Depression. It's not going to get rolled back. It's going to incrementally move forward until it's not sustainable, and it will eventually crumble under the weight of its own contradictions. And again, that's going to lead to the dissolution of the United States as a political entity, not in the next week, not in the next year, but I predict, within the next 25 years, the United States will not exist as a political. Why? It's not sustainable. It's not sustainable. The debts and it's just not sustainable. And goofy programs like this won't work. That's already been proven. So what's the antidote? So I might have mentioned this before. I've talked about it before. Again, all I can do is tell people what you can, people are thirsting for knowledge and information. And so an easy read is a book called Economics in One Lesson by Henry Hazlitt. Henry Hazlitt was a journalist back in the 30s and 40s. He actually used to argue. I think, wrote for the Wall Street Journal and other publications. He was a literary editor, and he was he was one of the first journalists or people to introduce the Austrian School of Economics to lay people in the U.S. And so he wrote a lot of short papers on different economic fallacies, and then it got combined into one book called Economics in One Lesson. This is not like a 400 or 500 page book. This is a very short book. The chapters on each economic fallacy are very short, and he is a very good writer, and he writes it in a way that's very easy to understand. So he incorporates and a lot of the things he wrote about that were happening during the Roosevelt administration that he was opposed to, or he would show the fallacy behind them. And basically, it comes down to this, and this is like the first two bullet points here basically sums up what the issue is. It says, this is from the introduction. The art of economics consists in looking not merely at the immediate, but at the longer effects of any act or policy. It consists in tracing the consequences of that policy, not merely for one group, but for all groups. I think this is one of the most best articulated ideas around economics. You know, our economics is such an opaque and hard to understand. It's not even a science. It's more of an, this choice of the word art is very important. It's so subjective. It doesn't like, 2 + 2 = 4 all the time, which we should know from. So I think that, but we know what human nature is. We know what motivates people. We know the history of incentives and disincentives. And we know that people are always going to try to do what's best for their own personal gain. And knowing these things, we can anticipate what the results of policies will be. And I think it's important what he says further on the end of the sentence is understanding the consequences. This is like going back to like Frederick Bastiat, who was a French economist back in the 1700s. So this is all traceable back to very smart people. This is not like new concepts. Okay, this is Ludwig von Mises, human action. This is Frederick Bastiat, the broken window fallacy. And then Henry Hazlitt, because of his great skill in writing, being able to condense it into a easy to read, short papers on these different subjects. And so part 2 of the book consists of 24 chapters. This is where the meat is, each demonstrating the lesson by tracing the effects of one common economic belief and exposing common economic belief as a series of fallacies. I give an example here, like chapter 15, how the price system works, argues that economic proposals must be analyzed for their long-term and widespread effects, not just their immediate and limited consequences. What Hazlitt considers the fallacy of isolation, or looking at an industry or process in isolation, is the starting point of many economic fallacies. The chapter explains the problem of production and consumption and how the price system works to allocate resources efficiently in a market economy. Remember, I talked about the bodega owner in Venezuela? It uses the examples of Robinson Crusoe and the Swiss Family Robinson to illustrate how economic decisions are made in relation to all other decisions in a society. So when Trump says, I'm going to do this for the steel industry or tariffs for this industry, what are the second order and third order effects of doing that? Yes, you may be helping those 80,000 workers in that industry in specific, but what's the knock-on effect of that? And is that knock-on effect worse overall for the general economy? Or did you get, your 15 minutes, your 5-minute news blurb about, helping this particular constituency at the expense of all other people? And that's what we see in politics, in the way our system's set up. And so I will put a link to this. It's on Amazon. I think you probably can even find a PDF for it for free online, but you can order it, and I would read it if you're interested in these things. It'll give you at least a little bit of an antidote, because a lot of people will ask me, well, what should I read? What's a good, these economic fallacies, these issues around price controls and this is all throughout history. Okay. And I don't see it really changing, just because human nature is human nature. And people are going to respond, especially in our society where so many people are struggling now, they're going to respond to it. Okay. Because they don't know how the political system works. They don't understand or accept the fact that this is a technocratic oligarchy of people, wealthy billionaires and such, that is in cahoots with the administrative state and the political class for their own benefit at the expense of the general population. It's just how it is. I use the term strip mining the middle class, strip mining the working class. That's what they do. Every time you turn around, there's a new fee, there's another cost, there's this, that, whatever, and it's always, to the negative for working people. And if you would free them of this, then people would be able to flourish. But, That somebody needs to do something, right? So they create the problem. I've said this before, just to sum all this up. These people create the problem, okay, or they create a benefit for themselves that creates knock-on effects for the average person, and then they come up with another scheme, that band-aid on top of a band-aid on top of a band-aid, instead of going and looking at, let's take all the band-aids off and look at this infected sore and deal with that. No, just keep putting band-aids on it, but yet the sore festers. So again, I'll put a link to it in the show notes. You can take a look at it. I would encourage you, if you're interested in these things, it's a very short read. You can read one chapter a day. They're just a couple pages. It's actually quite entertaining also. So I highly recommend Henry Hazlitt's Economics in One Lesson. So this kind of is a good segue. Gold makes a new high this week. As I pointed out last week, you know, if you look at Ronnie Steufel's work that he does in Gold We Trust, that his organization puts out, and then the monthly Gold Compass, they track, you know, gold's basically up double digits in most developed market currencies. I mean, I'm talking anywhere from 15 to 25%. Why? Because we have $315 trillion in government debt around the world, and these governments can't pay. And so we have this consistent basing of currencies all around the world. And so gold, which can't be created out of thin air because people have to go into the ground with machines and dig it out at great expense and effort, it cannot be, you know, just randomly increased with a keystroke at the New York Fed trading desk. And so this is what you have. You know, this is why we're in this era of hard assets. And so I think that, you know, I'm a long-term bull on gold. I would say that several gold mining stocks that I track are making new 52-week highs. Not all of them. You have to be very selective, okay? The juniors aren't necessarily. There are some stocks that have done well with some exploration success and things like that. But again, this is an industry that is, you know, a lot of gold miners that reported this recently are not showing good numbers even at these gold prices. Why? Costs are up, grades are down. Not every gold miner is going to benefit. Now, if this thing takes off and runs to 3,000 or 5,000 or something like that in a short period of time, yes, they'll all benefit. But I think you have to be selective and understand each company of what you're buying. Again, I've talked about Anglo Gold. I like it. I have other gold stocks in the portfolio. I don't have this in the portfolio. I've just talked about this company publicly. They are turning around their operations, and they made a new recent 52-week high. I've talked about Alamos Gold. I've talked about Agnico Eagle Gold. These are all companies that have made recent 52-week highs because their operations are benefiting from this higher gold price. They're able to take a higher gold price and transform it into higher cash flow. Not every gold company can do that. As a matter of fact, you know, raising production is getting more difficult. Now, we did see a pretty big merger this week. And so I think that if the gold price moves higher, or if it breaks out and takes off, which I think inevitably will spike at some point during the course of this bull market, which I think is going to be multi-year, then I think you get a big push higher in gold stocks. And I do think that a lot of the juniors will get into that stage like we do in a lot of these resource markets, where we will hit a stage where all of these things just take off because so much money comes into it. Again, a lot of money still isn't coming into this. Why? Because we're right back to business as usual, as I'm going to show later on in the regular equity market. I mean, we had a tremendous record-setting, something that has never happened before, happened with volatility in the last week or two, which I'll get into in a minute. But getting back to gold, you know, I've talked about it before. I like gold because it's insurance, it's savings. Okay. It's a currency like the yen, the euro, the dollar, and it competes against them. And it's going up because the other currencies are being debased against this currency. That's why. Is it going to fluctuate? Yes. Does it have an emotional response? Yes. Is it more volatile? Can it be volatile? Yes. But I think that what you can see coming down the pipeline, at least in the Western OECD countries, is debt, political sclerosis. Nobody's dealing with any of these problems or has any intent to deal with them. And so I think, gold is going to sniff this out. You're going to have more inflation, more money printing, more spending of money that people don't have, more debt. It's just, this is what gold, I think, understands, and people are, buying it to protect themselves against it. And again, you still have the impetus, as I showed last week, of basically gold moving from the west to the east. These people that hold all these dollars in the east don't want to hold all these dollars because they can see what's happening. And it's not going to be this mad rush into gold, but slowly but surely lowering their dollar reserves and replacing it with gold. And that's what we're seeing. So this is from Goldman Sachs investment research. Markets are again pricing more Fed cuts in 12 months. This is just for the next 12 months. Markets pricing 200 basis points. That's 2 percentage points. Again, I've talked about this before. The Fed does not cut rates there unless there's an economic crisis or a financial crisis like Lehman Brothers or something like that, or that we're getting into a recession. And I believe that we're probably already in a recession or getting ready to enter one. And once they start cutting, they usually cut quite a bit. So this is what the market's predicting right now. You can see all these other times when they cut, it was because of recessions. That's what's going to happen here. Again, we're either in recession or heading into one. And I suspect that, this is why I talk about buying TLT or going out further on the yield curve. If you're in T-bills, you're going to see your T-bills go down. So why not move a little bit further out on the yield curve? I don't think there's any reason to rush into a bunch of stocks right now when I still think we're going to have a big pullback in stocks at some point. If we're going into a recession, stocks over the long term are a reflection of the earning power of the companies, right? And so if you're going into a recession, the earnings will come in, and therefore the stock prices of the companies whose earnings are no longer growing as fast or actually in decline, the stock prices will reflect that. And because we're at such high overvaluations, you can anticipate that the pullback during this next bear market could be, I've talked about this before, 30 to 50% or more. Who knows for certain stocks. So I think if they're going to cut rates, you can have a trade of, move out further on the yield curve and get a decent capital gain and still get, your interest payments. They won't be the same 5% T-bill rates, because as they cut rates and those older T-bills roll off, the new T-bills they sell will be at the lower rates, right? So you really need to understand that. However, as we talked about last week, some people just don't want to do that. They don't like it. They have an aversion to it. They don't understand some of these things. That's fine. You could just sit in cash too. That's fine. But I think this is at least something to consider through the end of the year. So this is what I was talking about. This is from Jesse Felder. It says here, this is from Reuters. The 7 trading sessions it took the VIX to return to its long-term median of 17.6 was the quickest ever drop from 35. Similar reversions in the so-called fear gauge have on average taken 170 sessions to play out. So typically, when you have a spike in volatility like we had in the last couple of weeks because of the shock we had from this Japanese central bank and the unwinding of the yen carry trade, you see previous episodes, number of trading sessions before VIX closed below its median reading of 17.6. Obviously, the higher the VIX reading is, the more volatility, the lower the reading, less volatility. And so it only took 7 days for volatility to drop below 17.6. You can see, it's happened before, like 13 days, 21 days, 30, but you see other periods of time, it's taken, as we say, on average 170 sessions. So as soon as the Japanese central bank said, "Oh, we're not going to raise rates, market. We got the message. We're not going to raise rates in these precarious times." Then everybody went right back on to risk on that quick. So it's not like this. Hey, that's a potential to be a fat. I don't want to be that fat bug that connects with a windshield. They went right back to it because they don't have any choice. They have to perform. And so turn it back on. Coast is clear, with your brow, because we got to get this machine turned back on to crank out return, or we're not going to get our bonus, or we're going to lose our job because we underperform whatever metric that we're being, or KPI we're being measured on. That's why. And so expect this to happen again because the situation in Japan has not been repaired. They need to raise rates and they need to get their currency. As they raise rates, that will help strengthen the currency. The currency is depreciating against the dollar. That's creating problems for them, especially considering the fact that they import 100% of their oil and a lot of other materials. The country has no natural resources except for the people there and their brains. So they are never going to be energy independent. And so if their currency is depreciating, the yen's depreciating because they're printing so many yen, and they have to buy oil and coal and natural gas and iron ore and all these things, usually priced in dollars. They have to spend more yen to buy the same amount if their currency is depreciating. So this is the problem. This is why they were trying to raise rates. So we'll see what happens. But again, lesson was not learned. So expect a repeat at some point. Put that on your risk register as something that can happen again at any time. So this is Cross-Border Capital, Michael Howell. I've been following this guy on Twitter. I listened to some of his interviews. He has this proprietary liquidity index. I don't know what it consists of. I don't know if this actually matters, but he says that, liquidity is increasing based on his index here. And I say liquidity and sentiment drives markets in the short term. What I wanted to point out is, I do track central bank actions around the world. And up to this point in 2024, as of at least last week, we've had 100 central bank cuts around the world and against only 19 central bank rate hikes. And so, again, I'm staying on this, as Greg Weldon calls it, Money Fest 2024. I don't really know how they build this. I'm not a subscriber to their information service here at Cross Border Capital. So, but I have listened to his interviews, and he has explained how this liquidity index works and what the results of it and what he has seen happen with asset prices as his liquidity index either increases or decreases. So I'm just pointing it out. Again, I don't know how useful it is. I'm just pointing it out that's consistent with what I'm seeing central banks doing, increasing liquidity, lowering rates. Not to be too basic on this, but you can expect higher equity prices, higher asset prices. Again, as I've said before, in the US, we're going to get ready to enter a rate cutting cycle. As I pointed out probably a month ago in a video, if the economy in the US is not in recession and the Federal Reserve cuts rates, which is not typical, but it has happened, then the market will advance. It has a tendency to advance about 15% a year, 12 months after the initial start of cuts. But normally what happens is the Federal Reserve cuts rates because we're either economic weakness is coming in a recession, or there's a financial crisis like Lehman Brothers. And in that context, the market goes down. I expect the latter, not the former. Eventually you bottom, and then as the lag effects of that rate cutting and increased liquidity of the central bank makes its way through the economy like the pig through the python, that will result eventually in higher equity and asset prices. Again, the Cantillon effect. You really need to understand, because liquidity, like I said, and liquidity is the primary driver, which will then create sentiment, right? If the market's going down, sentiment will get poor and ugly until the liquidity is enough to overwhelm and start forcing asset prices up higher, and then sentiment will turn. So you have to understand the lag and lead and lag effects of all this and how these cycles play out. It's if ultimately over a long period of time, the individual companies' results will actually drive in their capital allocation decisions around stock buybacks and dividends, and how they actually run the business will determine the stock price. But like I said, in the short term, anywhere from a year to 8 months, something like that, it's going to be a liquidity and sentiment that drives stock prices. And again, in a bear market of stocks, if the stock market is in a bear market, those stocks will go down somewhat. Okay, even the stocks that we hold in our portfolio. But again, I'm not a soothsayer. I'm not looking at entrails of chickens. I'm not casting lots here. I don't know exactly what will happen. All we can do is try to set up probabilities and go from there. So this is something I wanted to show. I've talked about this before. This is kind of like when I've talked about the CAPE ratio, the cyclically adjusted PE ratio. But this is something that Jeremy Grantham talks about. Other, people. I subscribe to this view also. Basically, S&P forward PE ratio versus annualized total return over the following 10 years. So basically what this is showing on this axis here is the annualized total return for the next 10 years, okay? And this scatter plot, shows you when you have a high forward PE ratio, the higher the PE ratio is, okay, higher valuations mean lower future returns. Lower valuations mean higher future returns. This is why we have as our mission statement of the Actionable Intelligence Alert newsletter, sell overvaluation and buy undervaluation. There's been study after study. The data is clear. If you buy stocks at high valuations, your ability to make money long term is going to be very difficult. Maybe in an individual issue that has some certain market product or business that, allows it to go from overvalued to much more overvalued. We've seen that. But in general, the more you pay for security, the less likely you are to have returns. As a matter of fact, once you get around a 20% forward PE, you're looking at negative returns over the next 10 years. That's why when I show that GMO forward returns survey for the next 7 years, it shows U.S. equities having negative returns over. That's in general. That's not individual stocks. Some wag in the comments will be like, well, what about this stock? It went up. I'm not talking about individual stocks. I'm talking about the market in general. Okay. That's why I seek out low, and this is consistent across most markets around the world. It's not specific to the US. If you overpay for investments, your returns have a tendency to be low. If you underpay, if you seek out things that are undervalued and cheap, not garbage, stuff that's legitimate companies, but have been overlooked or are, undervalued, and it's out there, you have a tendency to outperform. As a matter of fact, if you buy securities maybe at like a 10% forward PE ratio, you're looking at, somewhere around 15% annual returns. It's very rare you're going to get stuff down between 5 and 10 PEs, but, we found these stocks. You have stocks trading in different markets in Asia that are selling it. There's companies selling in Singapore and Hong Kong for PEs of 3 and 4. Legitimate businesses throwing off cash, paying dividends. Same thing in Singapore, Hong Kong, Indonesia. So you have to expand your horizon. With the internet and the ease of travel, there's no reason not to make the entire world your investment theme. And many people have what I call home country bias. It's not easy necessarily all the time, but if you do the work, you can usually find a way to take part in undervalued situations or find a way, a proxy. I mean, there's companies that trade on the London Exchange that have, assets in, we have one company that's in Republic of Georgia. It's businesses there, but the stock trades on the London Exchange, and it's tremendously undervalued. It sells at basically a 50% net asset value, and the company's growing. It's basically a mini Berkshire Hathaway of the Republic of Georgia, which is an economy that's growing tremendously, that has done a tremendous amount of deregulation and market liberalization, and is doing fine. Notwithstanding the U.S. attempts to have a color revolution a couple months ago, which caused the stock price to go down about 40%, which in my mind was a buying opportunity. But it's out there. I have a conglomerate that I'm bought recently that I'm thinking about adding to the portfolio that has assets all over Asia, infrastructure assets, power assets. It has the largest noodle manufacturing company and seller in Indonesia, and it's selling for like a PE of 4 and a dividend yield of like above 6%. So why wouldn't I want to own something like that? I think over the long term, that has more potential. Okay, this is the kind of stuff that I really enjoy talking about, because this is, investing like this, though, takes patience. People want to get rich quick. That's a lot of the problem. So, if I'm getting impatient, I want this to do something, I want to get rich. On reading Twitter, this guy got rich on the XYZ tech stock that's selling at 100 times earnings and 40 times sales. Why aren't you recommending this? How come this gold stock that I bought in Vancouver didn't go up? You said gold was going up. I mean, guys, pay attention. This is not, it's not super hard, but there's certain things, like I talked about before in that one lecture. Most people don't have the constitution to do this. It requires patience. It requires fortitude to step in when things are cheap and no one else wants them, and see the value and buy, and then wait for that to play out, which could take a few years, the situation. We talked about offshore drilling when nobody was talking about it, when certain companies were they were on the verge of going bankrupt or not bankrupt. They were totally in debt. And so the entire industry has shifted now, because we knew that oil wasn't going away, oil and gas wasn't going away, and that the onshore basins were becoming more difficult and more expensive, and that there was still tremendous resources and opportunity in offshore. But what's important to see was that the industry of the offshore service providers had been decimated by 2 major oil field recessions, which had thinned the herd, thinned out the amount of machines, the people. And so the remaining players were now in the cuckoo bird seat and able to, as the recovery inevitably came, which it is now in recovery, they are able to benefit from that. That's what we look for. Wanted to point this out. I find this interesting. So 44% of small cap companies are unprofitable. And this basically shows you basically earnings per share, percent of unprofitable companies during the tech bubble, the financial crisis, the pandemic, and currently. And it's divided by large cap, mid cap, and small cap. You have right now 44% of small cap companies are unprofitable. If we go into a recession, one of the things I'm always looking for, and I've talked about this before, and it hasn't happened yet, I think, because so many companies were able to refinance when rates were basically at 0 for 10 years. It gave a lot of unprofitable companies that should have died and went away the ability to be like Walking Dead, aka that term that I've used before and you've heard in the financial press, zombie companies, to stagger and stumble bum forward when they probably should have been liquidated. But I think that if we do go into a recession and we get a decent recession, you're going to see, some defaults. And then hopefully, I really like to be in a situation, not that I want economic crisis, but economic crisis creates opportunity, right? And what I have done before twice in major economic dislocations is the ability to buy good corporate credit, because the problem is the problem with the bond market, like I've talked before, like corporate bond market, it's not traded like stocks. You can't just go on your phone and just say, okay, buy me 5 bonds of whatever, XYZ. You basically have to put the bid in, then the broker has to go look for the bonds for the price you want. If they're available, if somebody's willing to sell them, it's a little bit more tedious, right? It's not as liquid, is what I'm saying. You can't just go market order on XYZ tech stock and in 1/10 of a second or 100th of a second, the trade's consummated. It's not like that. And so what happens is if you do a situation where you get into a default cycle, people start selling bonds or bonds get downgraded. Well, certain ETFs and funds and pension funds, they have mandates. They can't necessarily hold bonds that are not investment grade, for example. And so they have to sell, say they have a bond issue that they're holding of a company and it gets downgraded to less than investment grade or whatever the threshold is for that fund, they have to sell the bond. And so that's fine if that's just the only company selling that particular bond, or institution selling that bond. But you get into a situation where everybody has to sell. You don't have the liquidity, so you get these huge price drops, right, in the bonds. That doesn't necessarily reflect the overall credit quality of the company. The company may be fully able and willing to make its payments and not be in danger of going out of business and defaulting, but because maybe they got downgraded 1 grade and it puts it below this certain threshold that people can't hold anymore, these institutions, they all sell in mass, you get a big price drop. What happens when bond prices go down? The interest rate it gets reflected in a higher interest rate. So you have the ability in a crisis situation to step in and buy a lot of good corporate credit. Again, during the great financial crisis, you were able to buy companies that ended up surviving, and after the crisis was over, the bond prices went back up and the interest rates compressed. But you were still, if you bought during the distress and you had a 20% yield to maturity, you were getting 20% regardless if the bond went up. Then you were getting a capital gain, which you could either take or not, or just continue to, clip coupons. So that's what I was hoping for during this, not hoping for, but what I thought would happen. But I think that so many of these zombie companies were able to refinance during the period of like 10 years of basically zero interest rates or longer, that it's kind of staved off a credit crisis. But I think if we go into this recession, we'll see what happens. It's not like a lot of these companies have to get in these refinancing cycles every 3 to 5 years. We'll see what happens. But yeah, I think this is interesting that this is current and we're not even really in a recession yet, supposedly. And we already have small caps struggling worse than they were during the tech bubble and approaching, distress that was present during the great financial crisis in 2018. Wanted to point this up. I like these little visuals. Global nuclear power capacity is set to rise by over 75%. That's to 2050. They kind of broke it down with these little cooling towers. Shows like China, the light blue is what they currently have, and then this is the proposed prospective capacity by 2050. And you can see China is on the, we've talked about this before. I just wanted to point this out. Nothing's really changed in the uranium market except for the fact that we're in summer and everybody's on vacation. I think that there's a big conference in September. Typically, a lot of deals are done then. So we'll see if the uranium market wakes up after Labor Day. Again, we're in this summer, sell in May, go away, come back on Labor Day. That's the old adage on Wall Street. So it really applies to nuclear power and uranium. So we'll see. The problem of not enough supply of uranium has not been solved. And so, yet you still see, again, go to WNA and look up or World Nuclear News, WNN, and look up the thing, new nuclear. Every week you've got something new new reactor coming online, new concrete being poured, new announcement of new construction, new announcement of whatever. So first criticality, first grid production. And so it rolls on. And like I said before, this is a worldwide phenomena, irrespective of what happens in the US and Western Europe. This is the global South and global East. Look at China, look at India, okay? Russia. I mean, this is where, this is where things are happening. So even smaller countries, the UAE, Egypt, they're all talking about more reactors. So just wanted to point that out. I'll probably throw this visual in the weekly email also. I like these kind of visuals. Kind of lets people get a good perspective of what's really happening. Oh, wow, that's a lot of growth coming. Where's the supply of fuel? Well, still waiting on that. That's the opportunity. Okay, guys, that's it for this week. Appreciate you tuning in. And again, avail yourself of the Actionable Intelligence Alert newsletter offerings if you are so disposed. All of that, ways to do that, are in the show notes. And also the link to the Henry Hazlitt book, Economics in One Lesson, if you're interested in actually learning why these fallacies exist and how they're debunked. It's kind of an interesting, easy read. That's in the show notes also. We'll talk to you next week. Thank you.